Good morning, everyone. It's good to have you all here. Thank you for your time. We have a question that we get asked quite a lot. Everyone asks it: what's the use of fixed income in a zero-rate world? What do you look at, and what are the things you should be considering? So, if we look at slide 2, we will see that this is our reality, right? If you look at what's happened since the Great Recession in 2009, and now it's also happened now in the Corona crisis, is that rates have been steadily falling in most economies. The USA had a brief period there from 2016 to 2019 when they managed to raise their rates. But as things stand now, both the US, the ECB, and the BOJ all have their rates pretty close to zero. The problem is that this doesn't even sketch the entire picture. If you look at what happens a little bit further along the bond curve, not just at the front, you will see at slide 3 that there's actually a range of problems. Rates fall and are below zero right across the curve. Now, I know it's sometimes a little bit difficult to interpret some of these charts. So what we've done is on slide 4, you can look and see how rates have fallen over the last effectively decade. That bright orange line is the zero bound, right? So if you look at all of those various rates, the blue line is the US bond curve. It's effectively what the US government is paying for debt anywhere from 1 month all the way out to 30 years. And you'll notice that the 30-year number there towards the back end of the curve is currently sitting at a little bit below 1.5%. If you take another step down, you'll see Japan, that's been famous for their low rates now for decades. The front end of their yield curve has actually dropped below zero, and the back end out to 40 years is sitting a little bit above 0.5%. And then when you start going to the European Union and to Switzerland, you'll see both Germany and Switzerland have their entire yield curves below zero. What does this mean? I mean, what are the practical implications of this? And why does it look that way? Right. So it looks that way for a couple of reasons. Firstly, we know that all of these countries, in one way or another, have quantitative easing policies. They are actively managing the level of their yield curve. That, combined with the low rates at the front end of the curve, leads to this. We've seen now, both during this crisis as well as during the previous crisis, how central banks have bought massive, truly massive amounts of government bonds and other securities. And that leads to this situation. But for an investor, it leaves you in an interesting situation, right? If you look at slide 5, what you'll see is the 30-year rate on these various instruments. And what $1 million or €1 million or €1 million or Swiss francs will get you if you invest for that entire period at an internal rate of return of negative 0.3 for Switzerland and 1.34% in the USA. Your million Swiss francs that you invest today in 2020 will be 900,000 Swiss francs in 2050. You're guaranteed to make a loss of 90,000 Swiss francs. And that gets even more bizarre if you look at slide 6 and you say, well, what does that actually look like for the back end, the complete back end of the yield curve? They have an interesting situation in Switzerland where the 50-year yield is actually more negative than the 30-year yield. It's negative 0.599. And if you invest for 50 years with the Swiss government, you'll have an investment of less than 830,000 Swiss francs. That leaves you in a bit of an interesting situation. And this trend has been ongoing internationally, as I've shown, for most of the last decade. And the reason this is starting to become important in South Africa is, to some extent, for the first time, we're seeing similar kind of effects in South Africa. On slide 7, you can see the last 22 years of the repo rate and JIBAR rate that we see in South Africa. Right? You can see that during the late 1990s, early 2000s, your repo rate was at above 20%. That's when the Reserve Bank decided to shift their policy to target inflation more aggressively. And for the first couple of years of the 20th century, the repo rate averaged somewhere between 12 to 13%. However, as time progressed, both the repo rate and the JIBAR rate started falling away. It fell from the peak in 2002, which was below 15%. The peak in 2008 was just a little bit about 12%. The peak in 2016 was around about 7.5%, 8%. And as we stand at the moment, we have the repo rate at around about 3.5, and there are discussions about potentially having another rate cut before the end of 2020. That would leave the repo rate at an all-time low for the last 2-3 decades of 3.25%. Now, while that's great for a home loan and it's great for a car loan, if you are an investor in either a money market fund or a fund like Ashburton Stable Income, that has significantly affected your return expectations. Right? So money market funds give you approximately 1% above repo, and the Stable Income Fund gives you approximately 2% above repo over a 12-month period. That means that clients that were as late as 2008, 2009, sitting between 12 and 15% returns on these portfolios are now sitting on 4 to 5% returns. Now we know what this does, right? If you look at slide 8, that lower expected return in yield in a yield environment, right? That lower expected return that you can get on cash and cash deposits, right? That engenders a couple of things. The first thing that it does is it engenders risk-seeking behavior. Clients start to move further along the risk curve because they are forced to. And depending on who the client is, that takes different forms. We've seen clients move from bank accounts to money market funds. We've seen clients move from money market funds to stable income. And we've seen clients in stable income looking to add maybe a little bit of duration or looking at other alternatives as they are looking for higher returns. Because while inflation is still at a little bit above 2% and the returns on those portfolios are above inflation, that doesn't necessarily mean that the income that's produced from those portfolios are sufficient for the needs of clients. Unfortunately, clients and portfolios quite often can't adjust their behavior enough or quickly to cope with yields falling as drastically as they have. Now, that also quite often leads to an inappropriate capital allocation. This was extremely true in specifically offshore. Because if you look at the yields I've shown you earlier, we can see that, well, yes, the front end of the curve is close to zero, but the 10-year point of the curve is below zero. In the case of Switzerland, the 50-year point is below zero. So the option of moving in Switzerland from a bank account to a bond fund doesn't really exist because you don't get any additional rate of return. In fact, putting your money under a pillow for 50 years is likely to outperform the Swiss bond market over the next 50 years. However, if you look at slide 9, in South Africa, we have a little bit of a different set of circumstances. And a lot of that has to do with the changing nature of our bond fund and bond markets. If you look at the purple line on slide 9, what you'll see is that is the Swiss yield curve out to 50 years. And the green line is the South African yield curve out to 30 years. And you'll see that the gap between our yield curve and theirs is effectively at the 10-year point, it's about 10%, and it goes up to pretty close to 12% at the back end of the curve. Investing in South African bonds gets you a 12% additional yield in local currency compared to investing in Swiss francs. Now, that doesn't necessarily advocate that you should put all of your money in bonds, but it does mean that South Africans, unlike people in other countries, have an alternative to invest their money, right? We still have the option of moving from cash to bonds and not skipping all the way directly into equities like we've seen so many other countries do. And if you look at slide 10, while that real yield seems to be a function of emerging markets, with South Africa having a real yield of 7, you'll see that the real yield that we offer compared to many other emerging markets are actually quite attractive. So Brazil's real yield in the 10-year space, as we speak, is about 4.5. Colombia is about 3.6. Indonesia is about 5.2. South Africa is currently sitting about 7. So it does seem to us that the South African fixed income market, the South African bond market, does offer opportunities that are not available in many other spaces, even some of its emerging market peers. And that's not necessarily just limited to nominal bonds. If you look at slide 11, what you'll see is the rise in the real interest rates on South African inflation-linked bonds over the last three years. We can now get a return on inflation-linked bonds between 4 to 5%, depending on where you position yourself on the curve. Now, please take into account that when you invest in these kind of assets, that it's not a guaranteed return of 4% above inflation every year. It's a return of 4% above inflation over the entire period of the bond till maturity. But getting 4% to 5% above inflation in an inflation-linked bond, and getting 6% to 8% above inflation in a nominal bond, does offer some opportunities for South Africans. Now, part of that, in my opinion, is that African debt seems to be slightly mispriced compared to some of its peers. But part of it is also, and we have to be honest with ourselves, the South African market and South African fiscus is riskier than it has been for the last 2 decades. South Africa debt now carries a lot of additional risk. And, however, I think we are being fairly rewarded for that risk, at least towards the front end of the yield curve. So if we talk up till about 2035, so about the 15-year bond, maybe a 17-year bond, that's generally up into that area where we think that clients can look at buying bonds for portfolios or adding duration to portfolios. It's also a good time to look at potentially adding some inflation-linked bonds across the curve. We've been buying some inflation-linked bonds closer towards the front end of the curve in the 2025 to 2029 area. So it's important to say and to acknowledge that, yes, South African debt does offer you opportunities, but yes, it is also offers you those opportunities because it is riskier, right? So what can you do to hedge that, right? Obviously, you can buy a range of options on that, right? There's a South African bond market options does exist. It's not as liquid a market as FX options, but it is an option. If you look at other options, you can look at a ratio of a split between about 70-30 of bonds for US dollar. One of the best ways to hedge the South African bond market over the last decade has been to invest offshore. The problem, once again, is that once you move your money offshore, what do you do with it? Where do you put it? Right? We've just seen that investing in offshore fixed income is going to get you 0% over the next 30 years. So what do you do with your money once you have that in US dollars? Well, if you're not getting additional yield for investing across the curve, right, you may as well keep it in cash. Right? South African rand depreciates by between 4 to 5% versus the US dollar on average every year, just due to inflation differentials. So you can just put it in cash. The other option is that you can buy US Treasuries. Now, US Treasuries are earning you 0.5%, so it does give you something. And US Treasuries have also been a pretty good crisis hedge, but from a return perspective, it's also not been that great. One of the things that's been interesting the last couple of years, last year specifically, has been gold. Now, one of the criticisms of the gold market has always been that you're buying an asset, but it's not income producing. Well, suddenly, neither is the US bond market, the Japanese bond market, or the German bond market. You are buying assets that are not income producing. So suddenly gold as a risk hedge starts making a lot more sense, because just like government bonds, it functions primarily as a risk hedge. It functions as an inflation hedge. And it also doesn't produce income like most of your bond markets. The other two things we can talk about briefly is you can look at some corporate ETFs. and you can look at some South African corporates and etc. So if we look at slide 13, you'll see just 3 bonds that are issued either by the South African government or by South African corporates in the offshore market. Right, so there's the South African bond maturing in 2025, there's a First Rand bond, and there's an MTN bond. And all of these bonds have a somewhere between a 4 to 6 year maturity, right? They don't take a lot of term risk, they don't take a lot of duration risk. And historically, one of the criticisms of buying US dollar bonds have always been that, you know what, we can get 7 or 8% in SA cash. Why would we buy a bond in the US earning 4%? And this is one of the areas where we need to reassess our views. Suddenly, you cannot get 7% in SA cash. So getting 4% in US dollars for the next 4 years in South African government bond offshore doesn't look that unattractive. And when you combine that to currency depreciation over a period and the implied risk hedge, that's definitely something you can look at. And you can see there, for example, that there are other South African corporates that are also offering between 4 and 4.5% and 5% over the next couple of years. If you look at slide 14, you'll see that there are other things that you can look at as well. Now, this is a slide that shows high yield in the US, crossover yield in the European Union. It shows the African CDS, and it shows the emerging market bond index spread. And we can see that all of these things are currently sitting somewhere between 4.5% and 6.5%. Now, it's important to make just one point on this, is specifically the yields referencing emerging markets have some kind of implicit reserve bank support or central bank support. They are actively being bought. The ETFs are actively being bought by the Fed. And that is partly what's kept this yield relatively low. Now, that does mean 2 things. It means that the downside risk on these things are probably somewhat muted, firstly, but it also means, like we spoke earlier about, that the capital allocation function hasn't worked properly, which means that the risk reflected in these spreads are probably somewhat incorrect. That means if you want something that's probably more accurate or better reflects the true underlying risk, looking at something like the emerging market bond index or index spread is definitely something you can look at as well. Now, just to end off quickly on the conclusion, I think that it's important for South African investors to spot that there's an increasing role for fixed income in our markets and in our portfolios. If you look at the 6 largest unit trust or CIS categories in South Africa, 3 of them, money market, multi-asset income, and short-term interest-bearing, are on the top 6 of the largest categories. That's grown significantly over the last couple of years. With the additional yields you can get by investing in duration and bonds, it's my expectation that a resurgence in bond allocations are likely going to be popular over the next couple of months and years, and that portfolios that can add duration are likely to outperform portfolios that can't. We need to reassess the role of all of the asset classes that we tend to look at, right? In 2015, 2016, and 2017, we were in a fortunate position where cash gave you significant outperformance of inflation. At least for the next year or 2, that's unlikely to be the case. And the other thing that we're going to need to reassess is the role of bonds in a portfolio. With return expectations between CPI plus 4.5 to CPI plus 8, bonds are no longer a safe haven asset, right? They don't price that way, they don't perform that way, and their return expectations aren't priced that way. But their volatility is still half of what equity volatility is. And at that kind of spreads and that kind of return expectations, adding a larger role for duration in a portfolio can be very valuable. It's important to consider all the various levers in a portfolio, right? The problem with credit in South Africa for the moment is partly an expectation of increased defaults, although our view of investment grade credit is there's still a lot of value. The primary problem for credit is that the base rate there is the 3-month JIBAR. And we don't have to be stuck in only referencing 3-month JIBAR. My colleague Chris, who spoke earlier, is an expert at transforming the return of a JIBAR-based credit portfolio into an inflation-linked based credit portfolio, or into a nominal bond reference credit-based portfolio. So looking at portable alpha strategies that considers both the benefits of duration and the benefits of credit can be very valuable. And I think it's important to look at a portfolio holistically, deciding which asset classes might have a comparative advantage in South Africa and which asset classes might have a comparative advantage offshore. Once again, thanks everyone for being here. I'm going to give on now to my other colleagues. And if there are any questions, we are always available to help. And I hope you have a good day. Thank you very much.